Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So imagine you want to start a dividend growth portfolio in 2023. So you have been looking at the stock market, you've realized it's time to put some money in the stock market and you want to start dividend growth portfolio. Now, I always talk about dividends because like I've always said to you guys, I like the income. I like the companies these companies that pay dividend, majority of them are dividend growth companies, especially the ones that I invest in. And what I mean by that is these companies do pay every single year, they increase that dividend. Okay. The reason they are able to increase the dividends is because they have a predictable revenue. So their revenue goes up and then the portion of the net income goes back to the shareholders, just like us in dividends. Sometimes they buy back their own shares. These companies have excellent free cash flow, which I talk about a lot in this channel. Companies that have a free cash flow are great companies that will not have any problems going forward. If the company does not have a lot of free cash flow, then that's when you start to worry about. Okay, so what I'm going to share with you guys today is if you were planning to start a dividend growth portfolio, or you've already started one, but you were thinking of what companies could I potentially add to my portfolio as a part of my dividend growth strategy, okay, in 2023. Maybe you've started already, you're in the midway through your journey, or you're thinking about some new ideas or some new companies that you haven't maybe seen already. That is where I come in. That's what I'm going to do today. So I'm going to show you 10 different companies. I'm going to show you the details of these companies, kind of give you an overview of the companies. Then if it's obviously, you're going to have to do your own research. I'm going to show you the Sharia compliance side of things. And then I've actually put this entire 10 companies into Save Dividends website, okay, to show you how much. So I basically equally invested $1,000 into these 10 different companies, and I'm going to show you the result of that as well. So stay tuned till the end to see exactly the dividend safety side of things and basically how much money you will make, what the companies look like, are the dividends safe, and so on. Okay, so I'll give you an overview towards the end. Now, if you like this kind of content, please like the video, subscribe to the channel, and please let me know if you have any questions. Okay, I know some of you have asked me a few questions the last couple of days. I'm gonna again start answering it inshallah next couple of days. Okay. Also, we've got two different videos that I've already done. I'm just going to release it next 2 days, I think, inshallah. The two videos are one for the dividend paying companies that are really cheap right now that you could potentially add them right now in your portfolio, and also not dividends but growth companies that you could potentially add to your portfolios. And the reason I'm doing that is because look at the stock market. Look at what happened in 2022. 2021, 2020, if you started around that time, everything was going to the moon. Everything was perfect, right? In 2022, the 3rd of January, the drop started. Okay, the drop started in 2022, early 2022, and it carried on all the way to the end. Look at the S&P 500. Okay, this is the ETF that tracks the S&P 500. It's down 20% for the year. The Dow Jones, okay, industrials, is actually down less than 10%. And the reason it's actually down less than 10% is because it includes a lot of dividend growth companies, mature companies with free cash flow. It doesn't include a lot of the speculative companies, if you like. And some of them, in fact, majority of the companies I'm going to talk about today come from this the Dow Jones Industrials. Okay, and then the QQQ, which tracks the Nasdaq, is down almost 34%. And this is madness, because if you think about it, in 2021, all the companies in this indices, okay, or index is actually was going to the moon. But this year is actually reversed. This is why you need to have a balanced portfolio. You can't have all Nasdaq companies. You can't have all Dow Jones Industrials, because they tend to underperform when the S&P 500 is doing really well. The Dow Jones will actually underperform sometimes. So you need to have a bit of a balanced portfolio. And that's why it's important to look around and buy companies in different sectors and different growth side of things, different so you look at the growth side of things, you look at the dividend payments and so on, right? And then kind of have a balanced portfolio. And that's what I try to do in my portfolio. So let's get started with this anyway. I don't want to make this video any longer than it needs to be. The usual stuff, we're looking for the everything from dividend side of things, in terms of profit side of things, in terms of free cash flow, the return last 10 years, and then future expectations, and then what Morningstar is saying in terms of valuations. And then the first company is no surprise. This is a Microsoft. This is a very well diversified company. They have a loads of different products. They are still trying to diversify their portfolio by adding, hopefully in the next couple of months, okay, by adding Activision Blizzard as the gaming side of it. They have a very wide range of products, and I can't see this company going anywhere anytime soon. And as you can see, it has a wide economic moat. Right now, they have a nice dividend. They increasing that dividend, okay, but 10% every basically in the last 5 years. They have increased it in 10%. Payout ratio is very, very low, and they have increased that dividend for 10 years now. They will pay you $2.72 every single basically stock that you own from that company. And they will be increasing that every single year going forward. The safety side of it is perfect, so 99%. Profit margin is good. Return on equity is good. They have $63 billion in free cash flow right now. Total return in the last 10 years, we're looking about 25%, 17% growth next year, 13% basically the next 5 years. Right now, it's discounted 27%. Okay, so the price should be around 320. Right now, we're looking about 240. Okay, so that's the first company. The next one is another, basically say, company that I own in my portfolio is in pharmaceutical company. This company has a loads of different cancer drugs and so on. Main one is Keytruda. They still have their patent intact for the next few years, so hopefully we'll see how that goes. They have a wide range of products and pipelines that are coming up in the next few years. Some of them are still in stage 2, stage 3 and so on. Right now they're trading $110 per share. I was buying this company when they were in the 60s and 70s. Okay, I'm up quite a bit on this company, and I'm not saying they're cheap right now, as you can see. Okay, they need to come down a little bit in order to get to fair value, but right now this is a quality business. Okay, that's the whole thing I'm trying to do here, is to give you some quality businesses that you could potentially look into and do more research. Okay, remember, I'm not a financial advisor. I'm just giving you some ideas of what you could potentially do. So the dividend is really good, 2.63, 7% growth in the last 5 years, 36% actually payout ratio, which is really very, very low, and it is safe, 99%. They will pay you $2.92. Okay, for every basically stock that you own from that company. Profit margin is perfect. Return on equity is good. They have excellent free cash flow. Total return the last 10 years was really good. Next year they expected 2% growth, but then after that 12% every single year, and that's probably why it is trading at premium right now. Right, so the next one is Home Depot. Very big company in terms of the consumer discretionary, in terms of home building side of it, home improvement side of it. It has wide economic moat, $315 per share. Dividend yield 2.4% right now, 18% growth. So this is one of the reasons I love this company. In the last 5 years, they grew this dividend 18%. Okay, payout ratio only 46%, 13 years of increasing that dividend, $7.60 for every share of this company that you own right now. Safety 87%, profit margin 10%, return on equity is actually not there at the moment. Free cash flow 10%. Total return about 19% in the last 10 years. Next year, just 2%. After that, 5 years, 5%. And it's actually been basically trading on premium for quite some time right now. $270 per share is where it should be. Right now, it's about $315. The next one is Nike. Okay, you know this company. You probably have a product to own. This company actually created in your household, and you probably buy their trainers and their, I don't know, jumpers or whatever. Okay, 180 billion market cap. It has a wide economic moat. Dividend is actually good, and they are increasing that dividend. It's quite low, but they are increasing that dividend 11% in the last 5 years, right? Payout ratio is quite low, they have increased this for 20 years. So another 5 years, they will become dividend aristocrat. They will pay you $1.36 for every share that you own. Safety perfectly 99%. Profit margin is good. Return on equity is good. $3.5 billion of free cash flow. Total return, you would have actually gained about 17% every year for the last 5 years, 10 years. Next year, they're expecting about 28% growth, and then after that, it's going to drop about 7%. 14% discounted right now, $134 per share. Next one is one I've talked about so much in the last few months in Union Pacific. I love this company. It's a railroad company. They actually transport so many goods between in the US and so on. $133 billion market cap, has a wide economic moat. Dividend is excellent, 2.5, 14% increase in the last 5 years. Payout ratio is quite low, 15 years of increase in it. $5.20 for every share that you own. 88% safety. Okay, profit margin and return on equity is actually really good. $6 billion in the bank right now, 14% in the last 10 years of total returns, and then 3% and the 9% next 5 years in terms of growth and earnings growth. Again, this is estimation from the analyst, so you just have to do your own research and find out a bit more information. One of the websites I started using recently is Seeking Alpha, that gives you almost the next 5 years in terms of earnings, in terms of and EPS, in terms of revenue. So you can use that, maybe check for, I think for free, you can check for the next 2 years at least. Okay, fairly valued right now, $203 per share, $207 per share right now. Next one is Waste Management. This is a company that I would love to own in my portfolio. I've said this many times. They basically are recycling company, so they take your garbage and do a lot of stuff with it, recycle it and so on. They are very predictable business. They are needed. They have a wide economic moat. It's one of those companies that if you probably live in the US, you will know more, but you wouldn't even think about changing these companies. So they will collect that garbage. They will do something with it. So there's a couple of other companies in the US that do the similar thing, but they are the biggest and probably the best in terms of financially, in terms of fundamentals, if you like. Price right now, 156. I actually expected this to come down quite a bit. 129 is the price target for fair valued for Morningstar. But dividend is not huge, okay? But they are growing it. 45% is their payout ratio, 18 years of paying that dividend, and then $2.80 is what you get. Safety 74%, profit margin and return on equity is actually quite good. $2 billion almost of free cash flow, 18%. This is probably one of the reasons last 10 years this company has returned 18% to shareholders, which is really good. Next year, 7% in terms of earnings growth wise, 12% after that. That's probably why it's trading a premium right now. Next one is Chevron. This is an oil company. Some people don't like oil companies or energy companies, if you like, but I do actually like Chevron. Chevron and Exxon are the only two companies, and EOG as well. Those three companies are my favorite when it comes to oil companies, but they've gone up so much this year. I think I did a little bit of research yesterday on Exxon, and it's gone up, I think, 76% since beginning of the year, which is absolutely huge if you think about it. But is one of the biggest right now in that industry. $347 billion market cap. It has a narrow economic moat. In terms of dividend, they are really good, and the payout ratio surprisingly is quite low, and the safety is 100%. So you get $5.68 for every share of this company that you own. I'll be honest with you, 2023, one of the things that I'm going to do is own an energy company in my portfolio. Not just because of the growth side of it, it's because of the dividend side of it, and the fact that they're not going anywhere anytime soon. That's what I want to say, okay? And the reason for that is, if you think about it, yes, EV is perfect. It is going to change the world, blah, blah, but that's not going to happen in the next 5 to 10 years. Well, not 5, 10 to 15, 20 years from now on. So energy companies will still be around. Right now, they are premium, so I would like it to come down. Hopefully, if the WTI actually comes down a little bit, then hopefully I can get it in the discount or whatever. It's just for the dividends and the basically diversification of my portfolio in terms, okay? In terms of the free cash flow, they have quite a lot of money in the bank, but they burn a lot of money as well. Literally, they use a lot of that money to kind of reinvest in their business and so on. So they need that. They need a lot of cash, basically. 8% next basically growth in terms of the last 10 years. Next year they're expecting it to actually come down. Obviously it will come down because the oil prices are coming down, so that means the earnings will come down next year. But the next 5 years after that, so 15% every single year after that, according to the analyst, which is probably why it's trading a premium right now. So energy is one of the companies, one of the sectors I will be adding hopefully into my portfolio very soon. Next one is S&P Global. This is probably one of my best companies, financials. This company basically does a lot of the rating side of things. They don't actually deal with banking side of things. Okay, so they just rating company. They rate credits in like bonds and all of that stuff, and different companies, different countries and companies and so on. Okay, so they are diversifying. They actually recently bought another company to their portfolio, added to their portfolio to kind of diversify just away from just the grading bonds and so on. $109 billion market cap. It has wide economic moat, $334 per share right now. Dividend is quite low, but they will pay you $3.40. The payout ratio is actually quite low, and the growth side of it is absolutely brilliant. Last 5 years, we're looking at about 16%. Okay, and then safety is 99%, so that's what you expect. Profit marginal return on equity is actually quite good, $2.3 billion of free cash flow, 20%, almost 21% total return in the last 10 years, right? Next year 13%, and then after that 8%, which is really good. It's fairly valued right now. Next few weeks I will be adding more of this company. Okay, so I've done just a bit of a research just this weekend, and I've decided to add at least another. I think I've owned 4 shares, so I want to make it maybe at least 5, 6 in the next few weeks, and then keep adding to it. So hopefully by the end of this year, I should own at least 10 to 15, if not 20 shares of this business. I will do more research if you would like me to, but for now, I'm going to leave it there. Lin is one of those material companies. They are in the chemical side of things, very similar to, in terms of business-wise, very similar to air products and chemicals. Okay, $161 billion market cap, so it's slightly bigger than air products and chemicals. It has a narrow economic moat, $326 per share, 1.43% dividend yield, 7% growth in the last 5 years, and then payout ratio only 38, so they have room to improve that. 29 years, so they are dividend aristocrat. Okay, $4.68 is basically the payout ratio. So this is what you will get for every share that you own of this business. Safety 99%. Okay, the profit margins and return on equity is actually quite good. 6.9% free cash flow, 6 billion, almost 7 billion basically. Okay, total return in the last 10 years we're looking at about 13%. Next year we're looking at about 7% growth, and then Yahoo Finance, for whatever reason, doesn't have the next 5 years for this business. But when you look at the Seeking Alpha, I'll show you quickly. So if you click earnings, if you go to Seeking Alpha, type the ticker symbol, click earnings, scroll down to earnings estimates, what you will see is, so the first part here is the earnings, EPS. Okay, so earnings per share. And these are the estimates. So 2022, 2023, 24, 25. So I just normally look at up to 2024. And as you can see, 12%, 7%, 10% in the next 3 years. Even if you want to go a little bit further than that, you can see it's actually growing nicely when it comes to EPS. And when it comes to the revenue, remember, this is what the analysts are saying. So there's 25, 26, 23 different analysts actually looking at the revenue for this company. So 10% this year, 1% next year, about 5% the year after, and then so on. Okay, so these are 5 people are okay, but 2 people I wouldn't worry too much about up to 2026, maybe up to 2025. That's that company. Right, so right now, as you can see, it's fairly valued, and the price should be about $347 per share. 326 is where it is at right now. So the final company is Procter & Gamble. This is one of my favorite companies. He's been trading at higher multiples for a very long time, because the sentiment has changed since 2022, right? And what has happened is a lot of the people that were investing in high growth companies now switched to dividend paying companies, and for that reason this is one of the best companies out there. So that's why it's gone up quite a bit. I wish I bought more of this company. I think I own 20 shares of it so far. The dividends is actually quite good. The growth is not great in terms of a 5-year growth rate. It's below what I normally expect, which is about 6% or more, but the yield is quite good. They have got payout ratio is not bad at all. The dividend streak, 66 years of increasing that dividend, and $3.65 is what you will get. Safety is 100% because you've got $13 billion in the back, if you like. The profit margins, return on equity is absolutely fine. 10% in terms of the last 10 years in terms of total returns. And then next 5 years, they're expecting 7% and then 5% every year after that. So this company is normally about between, let's call it 4% to 7% growth in terms of earnings every single year. And as you can see right now, it's quite expensive. So there you have it, 10 different companies that you could potentially add to your portfolio. So if you want to pause the video, take a picture, have a look at it, do a little bit more research, do that. I'm going to move on to the Sharia compliance side of things. And as you can see here, okay, every single one of these companies is either has a 100% Sharia compliance side of things or above 90, basically 3%. The only one that's questionable, if you look at Zoya, for example, is this company, Microsoft. And I've said it so many times that I think they're going to have to reevaluate that situation, because I don't think it should be 93%. It should be way higher, more than that, because of the advertisement side of things. That's probably why it's here. Everything else looks fine in terms of, out of all of this, the only one that is a little bit just above or just on the side of caution, if you like, okay, I would be in terms of the interest-bearing debt, is Union Pacific. I own it. I'm not worried about that. Hopefully that will come down if they started paying off basically some of their debt levels. Okay. Final thing I want to show you is I put this whole portfolio into Simply Save Dividend, which is a website that actually deals with basically I get a lot of my information from this website. So I created a portfolio for all 10 different companies. So what I want to show you is dividend safety for these companies. But before I do that, I've invested about 1,000, okay, and it's gone down a little bit because I did the video a couple of days ago, right? The portfolio, if you like. You will get about $19 right now if you invested in these companies. They basically equally, okay. The dividend yields almost 2%. The yield cost is 3.62. The beta is very low. This is what I love about these companies. Beta is important because it's not too volatile. It's not like the Nasdaq companies, if you like, right? Dividend safety is 100% likely safe, which is really nice to see. The dividend growth rate for the last 5 years for all these companies combined is 9.6%. So 10% or more is what I normally look for, which is really good. So if you can grow it every year 10% or more, that's absolutely brilliant. Diversification is actually quite good in terms of their overall portfolio. So 20% consumer discretionary. I think that's Home Depot and Nike, for example. Industrial, we got 20%, financials 10%, and then the rest of them is all 10%. If you look at from income perspective though, look at this, Chevron, you got 16%, Merck, and so on. So again, equally divided, but the higher ones are the ones that pay you slightly higher, obviously, dividends, okay? So there you have it. That's the portfolio. So let me just show you one more thing in terms of safety. So you can see every single one of these companies has either 99%, basically, or 74% to 99%, which is actually quite nice. So that means that they're not going to cut the dividends anytime soon, okay? In terms of forecast, for example, if you don't actually reinvested the dividends, okay, you are expected in 2043, just that 1,000, by the way, you expected about 122 from $19 right now to $122 by the time we get to 40. But if we reinvest it, okay, if we reinvest it, is $175 per share, basically per year. So you will be getting that much. Obviously, if you started this portfolio, by then the growth rate, look, from right now 9% to 11%. But that doesn't include you basically invested into the portfolio as well as reinvesting some of the dividends, okay? So there you have it. There's 10 different companies that you could potentially look into add into your portfolio. Every single one of these companies is Sharia compliant right now. If you like this type of content, you're still here, you're still watching, please like the video, subscribe to the channel. Let me know if you have any questions. I hope that is helpful, because when I first started this whole portfolio thing, this YouTube thing, was when I realized there was not so much, there were so many other people that were talking about dividends and all of this stuff, but 99.9% of the companies that they were talking about are not Sharia compliant and actually not great companies for Muslim investors. Okay, so that's one of the reasons I started this channel, and now I think I've done it for 2 years. I'm going to continue doing it, inshallah, with your support, obviously. So it really helps the channel, it helps me kind of, it gets me motivated when I see a lot of you commenting and a lot of you liking the videos and you say thank you and all that stuff. It motivates me. Like I've said, genuinely don't make much of money in this thing, and I'm not looking for money. I'm actually genuinely trying to help the community. So inshallah, we'll get there together. We will help each other. But as always, have a wonderful day. Assalamu Alaikum.